Just shifting to inflation here. Inflation is the most lagging indicator of the business cycle. You've seen this chart from me before, but if you're new, this is the median trailing 10-year delta adjusted Z-score of a basket of select indicators in months before and after recession starts. And so what I'm showing in this chart here is effectively the median Z-score of all the indicators in the housing basket, of which there, in each of these baskets, there's about, I want to say somewhere between 5 and 12 time series representing each cycle. And what we mean by delta adjusted, it sounds fancy, but all I'm doing is just making sure that the up means good and down means bad. So, for example, you have to invert jobless claims, invert the unemployment rate, so that up means good and down means bad. And so for the housing cycle, we know that it breaks down about 16 to 18 months ahead of a recession. For the order cycle, we know that it breaks down about 8 to 10 months ahead of a recession. The production profit cycle, right about 4 to 6 months ahead of recession. The employment cycle breaks down right on time, and then the housing, and then inflation statistics tend to break down on a sustainable basis, kind of 6 to 8 months after a recession starts. So, we've gotten a lot of immaculate disinflation here, so you have to expect that, okay, if we don't go into a recession, if we just avoid a recession, a no landing outcome in the economy, we're probably going to be stuck with a structurally higher level of inflation than we were prior to the pandemic. And that, markets obviously don't care about that now because we're not getting data that supports the rising expectation of that amongst market participants. But this could be something on the horizon that we have to deal with in the coming months or in the coming quarters. History confirms the Fed must break the economy to achieve its price stability mandate. So in this table, I'm showing a sequence of events in and around recession, GDP contractions, the private non-financial sector credit gap, the labor market, the stock market, inflation, and then ultimately what Fed policy does with the policy rate in and around recession. I'll draw your eyes to this particular column here. This shows the basis point change of the year-over-year rate of change of core PCE leading up to recession, a year leading up to recession. The median value is +5, and there's only one negative value in the entire sample. So what that tells you that is core PCE inflation tends to be flat to up heading into recession, not way down like it's been over the past several quarters. And so there is an immaculate disinflation occurring in the economy based on these two charts that we just discussed, or this chart in this table. And so, we have to live in somewhat of perpetual fear of when that immaculate disinflation process runs out. But again, you have to, sorry, I take that back. We don't have to live in fear. We need to just respect our quantitative risk management signals. If the global macro risk matrix transitions to a risk-off regime, we're going to elevate slide 58 and 59 in the deck and tell you, hey, this is now the modal outcome because we're now in a risk-off regime. However, we can, de-elevate it in the deck and say, okay, as long as we're in Goldilocks, the markets, the gods are telling me to focus on the positive stuff. And, this is, I think that's something we do that's very different than what everyone else does. But, quite frankly, if you're doing what everyone else is doing out there, which is listening to podcasts, reading tweets, and putting on trades, how in the hell do you think you're going to make any money if you and everyone else out there is doing the same thing? You got to do something differently at a bare minimum. And hopefully you're doing something that's better, that's different and better. And hopefully, we respect, we appreciate everyone for joining us because obviously you've chosen us because you do think this is different and better. And we agree as well.